Welcome to today's video where I will share my investment portfolio with you. We will see how it is divided among income, long, and trade segments, and discuss the instruments I have chosen for each section. If you are interested in how to manage your own finances and invest with a long-term horizon, you are in the right place. Don't forget to like this video and subscribe to my channel for more content on investing. Portfolio allocation. Let's start by looking at the overall structure of my portfolio. As I mentioned earlier, it is divided into three main parts: income, long, and trade portfolio. But what does that actually mean in practice? The income portfolio, which forms the foundation, is designed to generate regular income. This income can then be reinvested or used to cover personal expenses. This part is crucial for the stability and predictability of my financial situation. The long portfolio, although it makes up a smaller part of my overall portfolio, is invaluable for building wealth over the long term. Investments here are chosen with the aim of value growth, which motivates me to monitor the markets and look for opportunities that offer above-average growth potential. The trade portfolio is my playground for experimentation. Here, I try to take advantage of short-term market volatility for my benefit. Although this portfolio represents the smallest part, its management is the most intensive and requires regular market monitoring and strategy adjustments. These allocations reflect my personal risk tolerance and investment goals. Each part plays a unique role in my financial plan and helps me achieve diverse goals, from stable income to capital appreciation. Income portfolio. The income portfolio is the foundation of my investment approach because it provides a stable base. In this part of the portfolio, I hold cash in savings accounts, which serves as an emergency fund for unforeseen expenses. This cash also represents a liquid reserve that I can quickly mobilize for investment opportunities. Another component is corporate bonds, which offer me predictable income from interest and relatively low risk compared to equity investments. I choose bonds based on the issuer's rating and yield to maturity to minimize the risk of default and maximize returns. Dividend stocks and dividend ETFs are key components for generating regular income. I focus on companies with a long history of paying and growing dividends, which indicates their financial stability and ability to generate consistent cash flow. ETFs offer diversification and reduce the risk associated with owning individual stocks. REITs, or real estate investment trusts, allow me to participate in the real estate market without the need for direct property ownership. They provide me with income from rents and property appreciation, which represents an attractive combination of growth and income. The last part of my income portfolio is investments in crowdfunding platforms. These platforms allow me to further diversify my investments by providing access to projects that would be beyond my reach, such as real estate projects. These investments carry higher risk but also the potential for higher returns. Long portfolio. The long portfolio is focused on long-term growth and represents my commitment to building wealth. Growth stocks that I hold here are carefully selected from sectors with high growth potential, such as technology and healthcare. These companies often reinvest all their profits back into the business, which can lead to exponential growth in stock value. Growth ETFs are key to achieving diversification in this part of the portfolio. I have chosen ETFs that focus on specific trends or sectors with high growth potential, such as artificial intelligence or renewable energy sources. This strategy allows me to reduce the risk associated with investing in individual stocks, while participating in the growth of entire sectors. Bond ETFs add a stability element to my long portfolio. Even though I am focused on growth, it is important to also have stable and less volatile assets in the portfolio. These funds invest in a wide range of bonds, including government, corporate, and municipal bonds, which provide me with regular income from interest and help balance the volatility of growth stocks and ETFs. Trade portfolio. The trade portfolio is where I engage in more active trading and speculation. Here, I focus on speculative stocks that have the potential for quick gains based on market movements or specific events. These stocks are highly risky and require constant monitoring and a willingness to act quickly according to market developments. Cryptocurrencies are another part of my trade portfolio. Although the cryptocurrency market is extremely volatile and risky, its potential for high returns is undeniable. I make investments in cryptocurrencies with an awareness of possible losses and only use capital that I can afford to lose. In this part of the portfolio, I also experiment with various trading strategies, such as swing trading, and use technical analysis for making buying and selling decisions. The goal is to maximize profits and minimize losses, but I am aware that the trade portfolio is most exposed to risk and requires thorough attention and discipline. Performance analysis. In this chapter, we look at a key aspect of any investment portfolio: performance analysis. Understanding how your investments are performing is crucial for making informed decisions and optimizing your portfolio for future success. Performance analysis begins with compiling an overview of all your investments and their performance over a specific period. This period could be the past month, quarter, year, or any other time frame you consider relevant to your investment goals. Comparison to benchmark. The first step is to compare the performance of your portfolio to a relevant benchmark. This could be an index that closely matches the composition of your portfolio, such as the S&P 500 for U.S. equities or the MSCI World for global equities. Comparing to a benchmark allows you to assess whether your investments are outperforming or lagging behind the market as a whole. Return analysis. Next, focus on the returns of individual components of your portfolio. Examine which investments yielded the highest returns and which ones underperformed. This analysis will help you identify patterns of success and potential areas for improvement. Risk assessment. Performance cannot be evaluated without considering risk. Use metrics such as standard deviation or the Sharpe ratio to understand the volatility of your investments and their risk-adjusted returns. High returns may be tempting, but it's important to balance them with the potential risk of loss. Diversification. Review how your portfolio is diversified across different asset classes, geographic regions, and sectors. Effective diversification can help reduce risk and stabilize portfolio performance across various market conditions. Rebalancing. Based on your performance analysis, consider the need for rebalancing your portfolio. This may mean selling some investments that have grown excessively and now pose too much risk, or alternatively, increasing the stake in investments with potential for growth. Performance analysis should be a regular part of your investment strategy. It not only allows you to track how your investments evolve over time, but also to respond to market changes and adjust your investment decisions to better reflect your goals and risk tolerance. Planning and goals. In this final chapter, we'll focus on one of the most important aspects of investing, planning, and setting goals. Every investor should have a clear idea of what they want to achieve with their investments, whether it's building retirement savings, funding their children's education, or purchasing a home. Without clearly defined goals, your investment decisions may become chaotic and less effective. Let's start with planning. Planning your investment portfolio begins with understanding your personal financial situation, including your income, expenses, debts, and financial goals. It's important to set short-term, medium-term, and long-term goals, as each will require a different investment strategy. Short-term goals might include creating an emergency fund or saving for a vacation. For these goals, it's advisable to choose less risky investments, such as savings accounts or short-term government bonds, which will provide you with easy access to your money when you need it. Medium-term goals could be buying a car or making a down payment on a house in the next 5 to 10 years. Here, you can start to diversify your investments into stocks, bonds, and perhaps some funds. Long-term goals are usually related to retirement savings or passing wealth to future generations. Here, it's crucial to leverage the power of compound interest, invest in stocks and other assets with the potential for higher returns, though with higher risk, and maintain a firm investment discipline. Now, regarding goals, it's important that your goals are specific, measurable, achievable, relevant, and time-bound, or SMART. For example, instead of saying you want to have a lot of money for retirement, set a goal to have 5 million crowns saved by age 65. This approach will help you better plan and track your progress. In my portfolio, I have set specific goals for each part income, long, and trade portfolios to reflect my short-term, medium-term, and long-term financial ambitions. For example, in the income portfolio, I focus on generating regular income that will help cover daily expenses or support me if I decide to work part-time or retire early. In the long portfolio, my goal is wealth accumulation that will enable me to meet my long-term goals, such as a comfortable retirement or the ability to financially support my children as they start their lives. Finally, in the trade portfolio, I set smaller, specific performance and learning goals that can increase the overall return of my portfolio. Remember, investment planning and goal setting is not a one-time task. It's a process that you should regularly review and adjust to changes in your life and the financial markets. This will keep you on the right track to achieving your financial dreams. Thank you for watching this video. I hope you have gained a better understanding of how an investment portfolio can be divided and managed. Don't forget to like this video, subscribe to my channel, and turn on notifications so you don't miss future videos where I will share specific titles and strategies I use for each part of my portfolio. Have a great day and happy investing.